This video is going to talk about how do you invest your money smartly and strategically, and more importantly, what are the different asset classes you should be looking at and the returns that are proportionate to those asset classes. So my hope for this video is you get a couple of things. One, I'm hoping that you're going to have reasonable expectations for what your return should be on your real estate portfolio or on your stock portfolio. So over a 10-year period, what sort of return should you expect? The other thing I want you to do is make sure that coming out of this, you know some of the different asset classes that exist out there. I want you to know your biases. A lot of us have biases, and going into different asset classes, we all bring our preconceived notions about what we think the world is about, or past experiences, our uncles or aunts, or things people have told us. So for instance, for me, real estate's the big one. I am biased towards real estate. I had people in my family, I saw friends around me investing in real estate, and I've had some really fortunately good experiences in real estate, which biased me towards the real estate asset class. When I talk about asset classes, I'm talking about stocks, bonds, real estate, talking about things like gold, commodities, high yield bonds, treasuries, cash as an asset class, and even cryptocurrency, which you guys know I don't like Bitcoin, but we're not gonna talk about that in this video at all. We're gonna talk about overall returns. Hey everyone, so you've managed to save enough money at this point to start thinking about what you're going to invest in. You've embraced some of the frugality principles I've talked about on the channel, and now it's time to invest your capital. Or maybe you're a seasoned investor with several $100,000 or even $1 million in your real estate or stock portfolio, and you wanna know what sort of returns should I be expecting? What is a good 10, 15, and 20-year rate of return? How has my net worth performed against the standardized benchmarks like the S&P 500 or the Russell 2000 index for small cap? Or maybe you're interested in investing in cryptocurrency or real estate and you want to know the annualized returns. We're going to talk about all of that today. So this video is going to help you understand all of the annualized returns. Just remember that past results do not necessarily predict future. I do like to prioritize cash flow and dividend paying stocks over appreciation plays. That's been one fundamental thing that I think is really important in anyone's portfolio. In this example, I picked a asset allocation of 15% large cap stocks, 15% international stocks, 10% small cap, 10% emerging, 10% emerging markets, 10% REITs, real estate investment trusts, and 40% high grade bonds with basically an annual rebalancing to that standard asset allocation. That is the benchmark we use, and I'm going to talk about each of the individual asset classes in greater depth. So what is an asset class? And I talked about that a minute ago here. We sort of briefly mentioned that it's real estate, cash, stocks. Within stocks, there's emerging market international stocks. There's domestic stocks, like if you're in the United States or Canada, within your own market. Within that, there are tech stocks. There are many different varieties and diversities of equity that you can hold or debt that you can hold, which is bonds. What are the annual returns and what should your portfolio look like? I just gave you guys a sample of one, and I think the best way to hold that type of asset allocation is using exchange traded funds or ETFs. ETFs are my favorite because they have low management expense ratios, low MERs. Mutual funds are like the ugly cousin of the ETF. They have high management expense ratios, and your financial planner tends to make 1% to 2% on your overall portfolio each and every year compounded. So if you look at that over a 20, 30, 40, 50-year period, you will lose about 1 or 2 doubles on your portfolio. So roughly, if you had $1 million that turned into 5, of that $5 million, about $1 million of it over the whole time goes to the financial advisor. So just remember when you're buying, your stock portfolio, that you should try to look for low management expense ratios. But let's look at some of the data because I got it right here in front of me. So over the last 15 and 20 years, the large cap stocks, so the S&P 500, annualized a 7.77% rate of return. That was the average. And the best year had 32.4%, and the worst year, negative 37%. So while the average is 7.77, and if you held it over a 10-year period, you get 7.7 each and every year. But some years are way down, some years are way up. So there's a lot of volatility in your type of return, but over a long enough time horizon, you will see around an average 7.77% if that was all you were holding within your asset class, within your portfolio. The next is the small cap index, the Russell 2000, 7.49% over a 15 and 20-year time horizon, pretty much the same for both the 15 and the 20 year. We're going back to around late 90s, right? Before basically 2 bubbles now. 38.8%, the highest of the best year of the 15 or 20 years, and 33.8% down was the worst. So there's still quite a bit of volatility in that asset class. International developed stocks, we're looking at the MSCI EAFE index, 5.22%. It's actually relatively low, holding a lot of like European type stocks and a lot of international developed stocks. didn't perform nearly as well. And the variation actually, the worst year was 43.1%. So I had a bit higher standard deviation and 32.5% on the higher side. Next, we've got REITs, Real Estate Investment Trust. So a REIT basically buys commercial or residential real estate. They buy a whole bunch of it, they lever it up, and they pay out their unit holders that actually own the real estate distributions each and every month, cash flow every single month, similar to a dividend, but treated slightly different for tax purposes. REITs, believe it or not, performed 8.52% annualized return, higher than the S&P 500. And yes, for those people who are waiting, real estate had the highest return of any asset class over a stabilized 20 or 30 year period. But if you look at single family homes, there was only about a 3.2% rate of return. So what we know is that if you're not buying for cash flow and you're just buying for appreciation over a 25, 30 year period, your rate of return is around 3.2%. Over the same time period, I went and took a look, inflation was around 2.3%. So you're basically beating inflation by 1% owning single family houses on average in North America. That's a scary statistic to think about. A lot of people are just buying single family homes for appreciation and they're not focused on cash flow. The REITs, for instance, the real estate investment trust that you're buying, those guys, they're smart. They've got their money invested in cash flow producing properties. They're getting appreciation, plus they're getting cash flow. That's why they're able to give those types of returns that they're giving. And let's remember, that's REITs use leverage. They go and they take your capital, your money, you invest with them as a unit holder, on the public exchange, or there's private REITs as well you can invest in. And they take that capital and they lever it up. So they go borrow debt against it and buy a greater asset. So if they take your $100, they'll go buy $300 in real estate asset. Cheap debt, levered debt adds value, right? So you basically get the spread between the cost of their debt and the return on that investment. So very, very important to think about leverage making real estate really powerful. Real estate without leverage is not a good asset class. Owning properties in cash is a bad return on your investment. We can see that the data suggests 3.2% 20-year annualized average return. That's about 1%, 1.2% over inflation. That's not a good return on your money. But if you bought those single family houses and you rented those single family houses out, you're getting some rental income plus that 3.2% appreciation, and you bought them 20% down. So you levered up, 80% of the money was paid for by the bank. It means every dollar you put up, the bank put up $4. You're buying $5 in real estate for every dollar you put up, right? So that allows you to basically have a 5-to-1 levered return. So that 3.2% becomes 15% when you lever it up with cheap debt. That's where real estate gets really, really attractive. You can't go to the bank and borrow 5-to-1 to buy a stock. You can go to the bank and 5-to-1 lever to buy real estate. So that's where it's really interesting. That's why on this channel we talk a lot about real estate investing, because the power of cheap debt. If you're not gonna borrow any money and you wanna buy real estate in cash, I'm not gonna tell you real estate's a good investment on your money. It really honestly isn't. You'll probably get single digit returns. You're probably better off honestly buying into a REIT that will lever your money for you. Leverage is good in this case, and so that's why we're gonna sidebar that conversation, because I'll talk about that on the Wise Wealth Show and talk about that on my channel and other videos about the beauty of real estate. But actually real estate did perform really well when you looked at levered real estate. And obviously REITs are not the best because REITs do under lever. They can't lever near as much as you could if you're buying your own real estate. Plus you have no control. Some people don't want control, and that's okay. For the people on my channel who are watching, who are like, Mike, thank you for finally making this video. They are finally gonna subscribe to my channel. They're gonna smash that like button to jump in the comments. I've gotten a lot of responses actually. I can think of like 5 or 10 individual responses from people on Instagram reaching out to me at Mike Rosehart and saying, I wanna see a video on what I invest in. What does the perfect portfolio look like? Should I be buying stocks? Should I be buying bonds? What asset allocation should I have? And I just at the start of the video gave you one example of a decent asset allocation. And some people are messaging me saying, should I buy cryptocurrency? Should I just be buying real estate? What should I be doing? What are you doing? Well, what I'm doing, my portfolio looks a lot, actually I'm really heavy in real estate right now. I do have some stocks. I do have some dividend plays happening. I have in my tax registered accounts, like my tax-free savings account and my RRSP, I invest in public equities. That's a place where I can buy stocks and participate in a lot of that equity growth. I do have some money in equities, and I do have some lending going on as well. I love private lending through things like Lending Loop's a great one here in Toronto. You can lend business to businesses, so you can get like an 8, 10, 12, 14% rate of return for lending to other businesses and other people. I like lending because it gives a little bit higher overall return. The thing is, the risk is commensurate to the rate of return. And if you're not smart about picking who you're lending to, you have much higher risk exposure. So that's the downside. Whereas investing in public equities over a 10-year period, no matter what you do, you're gonna go one way up. If you hold the S&P 500 and a collection of other indexes across the world over a 10-year period, you cannot lose money. It is impossible. Like unless the world literally blows up, we will be just fine and your portfolio will grow. You'll have 1 year where it's, let's say the worst thing happened, we go into a huge recession. This inverted yield curve is hinting that maybe we're going to a huge recession. Let's say that happens, let's play that out, and it happens just like 2007, 2008. By 2010, 2011, all of the losses were fully recovered. All you have to do is be diversified in your portfolio. I mean, don't just buy stocks like individual stocks like Lehman Brothers, etc. You want to own the collection of everything. If you own a collection of everything, you own an index, you buy an ETF, you're good. You hold over a 10-year period and everything will recover. So if your time horizon is good, you're totally fine. Time horizon is really important. If your time horizon is 1 year, maybe it doesn't make sense to get into public equities that have a lot of volatility. It might make a lot more sense to invest in something more stable, something you can actually have a bit less, more like a treasury or a bond, like a high grade bond. I'm gonna get to that in just a second here. Actually, so high grade bonds over a 15, 20 year period, 3.87% annualized return. The lowest year was -2%. The highest was 7.84% rate of return. So you can see the standard deviation is not very large here in this case. While you're only getting 3.87% return, there's almost no year where you lost. So that's a good place to park your money. It's a relatively safe place to beat inflation. High grade bonds are safe. They're like the main one is Barclays US Aggregate Bond Index. It's one of the main sources of data for the 20-year annualized return. So that'd be one you could just buy that index and set it and forget it, right? And have that maybe be 10 or 20% of your portfolio. In this case, many financial planners recommend 40% if you're in retirement. I would say a 90% equities, 10% bonds is a much more aggressive yet longer term viable strategy for asset allocation. So if you want the ideal, I think it's 90% equities, 10% bonds. I honestly do. If you have a long enough time horizon and you keep 1 or 2 years of living expenses set aside, you're totally good. You don't have to worry. You have that in times of recession. You can draw on that emergency fund. You don't need to cash out your equities when they're down. You can wait for them to recover. Oftentimes within 2 and 3 years, you've got full recovery. And then we go into another huge boom cycle where you can get double and triple returns on your capital. Those years I was talking about where you're getting 33% up years, those are the years you want to be holding the shares, right? Hold them through the down, dollar cost average, and on the way up, you'll be totally good to go. So then we have cash, which basically is like treasury bonds. You can sell anytime. You're looking at about 1.25% annualized return. Depends on the overnight floating rate and what prime interest rate is at. The worst year has been 0 ever. Like you literally can't lose money when you're holding in cash, but you can lose your money to inflation. Remember, there's still inflation at 2% every year, eating away the buying power of your capital. Next is high yield bonds. So high yield bonds are riskier. Like we're thinking, not quite junk bonds, but in that range. Some years you have 57.5% on the best years, and then the negative years negative 26%. So safer than equities with a higher overall upside, and 7.13% overall average is a great return. So if you're gonna hold those 40% bonds like I talked about in the original asset allocation that JP Morgan used in this study, you wanna make sure that you're holding a good percentage of high yield bonds with high grade bonds. So high grade being really good quality, high yield being better performance. So investing in businesses that maybe aren't rated by Moody's or one of the big rating agencies near as well. So they're not like AAA, high quality bonds are a little bit lower quality, maybe B grade bonds. So that's sort of overall, those are the asset allocations. You guys have been waiting to hear. Did you get it right? Did you guess that over the 10 or 15 or 20 year period that those would be the returns you get on your asset class? For those people who jump on my channel and say to me, Mike, this 4% safe withdrawal rate thing you keep talking about, this whole idea that you can withdraw 4% from your portfolio for infinity and leave inflation in your portfolio, that's not achievable. It's impossible, Mike. Let's look at historical data. I just gave you some historicals over the last 20 years. If you withdrew 4% from that asset allocation portfolio that's performing, the one I talked about in the beginning that was about 40% bonds, 60% equities with large cap, small cap, all the asset allocations I just talked about, that one performed at around a 6.67%. And the worst year was negative 22%. The best year was up 24.6%. So negative 6.67%, or sorry, positive 6.67% average over a 7-year period. Basically, if you use the rule of 72, which basically means divided by 72, you get that and how quickly it takes to double your money. Over a 7-year period, you would have doubled your money. So if you start with $1 million, you'd be doubled within 7 years using that asset allocation. Now, if you withdrew 4% and left inflation in your portfolio, using that asset allocation, you would never have depleted your principal. In fact, your principal would be 1.4 times what it was when you started. So most people in the early retirement world withdrawing 4% from their portfolio, they actually are further ahead than they were when they started. They had more capital than when they started, even after accounting for inflation buying power eating away from their portfolio. So you're gonna be totally fine. The 4% rule does work. If you want to be super conservative, maybe you work a part-time job in retirement. Maybe, worst case scenario, you have a side hustle like YouTube or a real estate portfolio, or maybe you just like to do camera stuff on the side. Whatever it is you love to do, teach piano on the side, do that. That'll ensure that you never have to dip into your principal in your retirement. I'd like to hear in the comments, what's your portfolio look like? Do you have, like me, I'm like 90% of my net worth currently is in real estate and businesses. I own some businesses as well, so I have interest in private businesses that I control and real estate. And the reason for that is I like to control my investments. Despite knowing all of these returns and knowing that I could do a set it and forget it strategy and collect about a 7% return pre-inflation, at the end of the day, I feel like I can get, and the data suggests, looking at my past 7 years of my own performance, I'm delivering 25 to 100% return on my own investment just from rental income. That's not appreciation. That's in a flat market. I'm getting 25 to 100% return on my money because I'm buying properties that return 1% of the value of the property minimum per month in rental income. So that's a really sound strategy. When you're investing like that, the only way you can lose is through bad management. So as long as I manage my properties well and I ensure that nothing happens to destroy the property and I continue to collect rental income, I'll be okay. Plus, there's always the upside of appreciation, and I buy my properties at a significant enough discount that I can't do in the public market. I can't go in and say, hey, I want to buy shares of Apple, 80 cents on the dollar. Who wants to sell to me? No one's going to sell in the open index to me 80 cents on the dollar. People will sell real estate to me 80 cents on the dollar. Thankfully, it's not an efficient or smart market. That's why I retail arbitrage the hell out of buying single family duplexes, triplexes in my area. We've got so many properties that we do. Looking forward to talking to you guys in the comments about your different strategies you're using and the types of returns you're getting on your real estate portfolio. I honestly think real estate is one of the best because you have full control, but you teach their own. And for those people who don't want to buy real estate, that's okay. You can retire early on a 7% rate of return easily. You can leave 3% for growth and take 4% out. That means you need 25 times your annual expenses to retire early. And if you're going to retire early right now and you've got 25 times your annual expenses set aside net worth, just invest it well, invest it smartly in one of the asset allocations I just mentioned previously, and you'll be just fine. You're ready to go. You'll be just fine in retirement. Remember, the secret to unlocking wealth for you: spend less, earn more, and maximize those returns. Maximize that difference between what you're earning and what you're spending, which is what you're saving, and you'll become a wealthier you. Thank you all for watching, and I look forward to seeing you in the comments.